Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what social media is sharing. There is something I want to touch on here that deals with a lot of people are talking about it. So I want to give my opinions on it. It deals with the waves of inflation, and people think that it's going to continue like that. And I'm just going to interject what I know about it. You guys can determine for yourself if you think it's going to do that or not. But uh, I'll give you my financial opinions as we go through here. It's going to be wealth related, commodity related, or financial topics. So let's dive in and let's see what's going on with social media and what people are talking about. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. We have midweek updates and question and answer sessions on the weekend where I can answer a lot of your questions about where we are in the cycle, about what individual companies I'm buying, and stuff like that. We do have a discount coming up called Spooky that is only valid for 1030 and 1031. And that's in the description link below if you want to look and how much the discounts are. They're big discounts. So, game of trades, and this is what I'm talking about, this inflation. It says if this continues, it won't end well. Inflation similar to the 1970s, year over year percent change in consumer price index. And this is what it shows for 70, 75, and 1980. And we get these three impulse move waves. And a lot of people say, well, it moves in three waves, or it has three impulses, or whatever it is. One of the things that I noticed when I was looking at some of the data for real estate, and I'm going to yank that up real quick so you guys can see the similarities. So this was the three impulse moves in annual percent change in population. You're probably wondering, well, why am I looking at people who are born in the 30s and 40s? Well, those people that were born in the 30s and 40s is the demographic that caused the inflation in the 70s when they were in home buying years, having kids, buying furniture for their homes, but having all this demand for whatever the heck they needed as they went through their 20s, 30s, and into their 40s. So you have to add 30 years to this to get you roughly the demographic and the credit expansion from that demographic. So I know that we were looking at that and there was three waves. Look at this. Wave one, wave two, wave three. it's the demographic that also had those waves. Now, if we look over to the right, this is the demographic that's coming right here. This demographic is kind of an impulse move up, and it's just one impulse move. And we know we've got an imbalance in the housing market. We know that millennials want to buy homes, and we know that the inventory levels are tight. Are we going to mimic the three-wave move? I know we've got a wave here that came up, kicked up a little bit, and then we had a bigger wave. So difficult to say. Difficult to say. Another thing that I noticed when looking back in all these history here, I'm going to go to U.S. new single-family months of remaining inventory. In the 70s, you can see that we had these humps. In the 60s, we came up, came back, came up, came back, and then came up in the early 80s, and then came back in 84. So this is your impulse move waves. Now, I don't know if the demographic had an impulse move. I don't know if it was related to the interest rates going up and how it choked off whatever. But either way, we built too many homes in the mid 70s and the late 80s. So that demographic, whether it could absorb it or not, we built too many homes. We are not in that same situation. We are more like in the 2000s where we have very low inventory, very high interest rates, and if there is a slowdown in the market, it's not like the 70s where we overbuilt multiple times, which was the mid 70s and the late 80s. We can even see the the way that the housing starts went up, overbuilt, came back, went up, overbuilt, came back. And in 1980, that's roughly where this green line is. That's when it came back below the average. Now, we've come on up, and we've pulled back to that average. Are we going to go back below it, or are we going to move on up? And that's really what we need to figure out to see if the inflationary pressure continues. But right now, the three waves and what it looks like in history, and what I look at housing starts, and what I look at in the demographic and the inventory levels, they are not equivalent to where we are today. I understand a lot of people think that we are going to get a potential recession or a move lower. I don't think it's going to be from the housing market. I don't think it's from the demographic, which means it would be more like the 2000s dot-com bubble, where interest rates go up. We see companies perhaps have some problems with bankruptcies, or companies that existed under low interest rates cannot exist under high interest rates. And that stuff has to get flushed out of the system. It is not being driven by the real estate market. Now, these humps in the middle here that came down, those were driven by the real estate market. They were not driven by something else. So all these, in my opinion, are these humps were driven by the real estate market, which was credit expansion into the system. There's also, this is all from credit expansion of the demographic and lending. This would be commercial lending against residential real estate in the free market. We could have increased lending in 2020, 2021 that kicked off a credit problem, a debt or credit problem. So that very well could be the case, and it would look very much different than this. I even have data going back to 1890. I don't think it's, let me see if it's in this one. I don't think it's in that one. I have data going into 1890, where in the 1940s, we also had a gigantic housing market boom. 40s, 50s, 60s, and 70s, all the way up. In the 70s, it went to an entirely different level. And I think that's where the inflation was rooted in. And now we've got the millennials kind of pushing us almost into could be a credit problem. I don't know. But those are the differences between now and the 1970s that I noticed. It says, caution, yield curve has begun steepening rapidly from inverted levels. This brings the economy closer to an economic downturn, according to him. Now, there are some stark differences between these yield curve inversions here. What people are doing is they're looking at data, and then they just look at it from one dimension. They say, well, when that goes up, therefore we get a recession. And that very well could be the case. I'm not denying that it can't happen. But right now, at least from what Powell says, he's going to hold higher for longer, and the long end of the curve is what's coming on up. And that has occurred in some of these instances. Now, the thing where I get tripped up is this slowdown is not rooted in a real estate market slowdown. So it is not rooted. We have low inventory, and we haven't built the homes for the millennials to purchase. There's still shortages in the market. And I know some people are going to try to debate that. Okay, let's see the data then. Most of these that we see of the yield curve coming up and the steepening, those were caused by real estate markets. Real estate market here, real estate market in the mid 70s, real estate market early 80s, real estate market in 89, 90, real estate market here. And the only one that wasn't was this one here. Could we get something where we come back up like this and then shoot back lower? I don't know. Can we stay inverted for a while? That's where people don't know. They really don't know what's going on here. Now, I'm in the camp, if they lower interest rates, I think that the housing market's going to reignite. and then we're going to get inflation from the housing market. So Powell stating that he needs to hold it higher for longer for a couple of years is probably correct. He's going to try to slow that all down. During that time, though, it would probably mean that the yield curve would be flat, inverted, or maybe it normalizes, but the long end of the curve is what normalizes and the short end stays high, which is slowing down the real estate market, which is exactly what I think he is trying to do. So it's difficult to say if we're going to get a recession slowdown. I know a lot of people, they just jump on this data and they say, yes, it's definitely going to slow down. We're going to get a big crash, and then they're going to re-stimulate. I want to go and rebuy. I wouldn't be so quick to that, because we could be inverted for a while, or we come back and we kind of relax to a state that goes sideways, much like the early 60s, and we don't get a huge crash. We just kind of go sideways with the yield curve kind of flat, but at a much higher level. Again, we'll have to see. I don't know for 100% fact that is going to happen, but that could be a possibility. During that time, where we have 2-3 years like that, we could see oil take off, uranium take off, and all of those commodities, while the curve is kind of working its way sideways. So that is generally when those commodities take off, is when the yield curve's inverted, or it's kind of moving sideways at a low level, I should say, flattish to low level. So I don't know if the people are who say that they're gonna, we're gonna have a recession, go to cash, and then I'll just buy it after they re-stimulate. What if it's higher for like 2 or 3 years and you miss the entire commodity bull market? That's kind of where my thought process is. There's ways to play this too. I think, gold, precious metals, I think, are decent when you get down here. And even if it stays down here, precious metals, I think, will do well. So I just, comments that I wanted to make on this. Here's another one. Home prices are contracting sharply, aggressively. These levels were only seen in 2 times, the 70 and 2008. 1970 was the beginning of that bull market for commodities. Both ended up in sharp economic downturns. Now, here is another problem with the data, and I'm going to describe it. So this is the median home prices. Median home prices. So yearly percent change in median sales price of houses sold for the United States. This data is misleading. So I'm in the engineering camp. I look at data, read data all the time. In 1970, I can yank back up. Let me yank back up that presentation I had. I'm going to show you something. So here's your inventory. In 1970, we had the inventory come up, and then we have it come on back in 1970. So we were in like a little mini real estate bubble, is what we were in. So we could go to this other chart that we've got. Here. So they said 1970, the median price went down. And then they said, okay, we had the median price go down in 2008, and now we've got the median price going down in 2023. There is a huge difference, and why this is misleading people. We had high inventory, we have no inventory. Mortgage rates shot up and affordability came way down. You know what's happening? And this is what is misleading. His statement, home prices are contracting sharply, aggressively, that is a false statement. He is wrong. He does not know what he's trying to show here. And the reason it's wrong is because the median home price, yes, they are selling cheaper homes in greater quantities in terms of sales price. So yearly percent change in median sales price, what happens is the high end of the market is not selling. The low end of the market is where all the sales volume is at. So when you take the median home price of the total sales, your median price is declining, but that's not per home specific. The houses in terms of pricing is not going down. When you look at the median sales price, it means that the volume of cheaper homes is moving more aggressively. Does that make sense? So your median home price is a cheaper price because those are the homes that are selling in volume. And when you take a median means the middle. It does not mean the average. Median just means that of all of these sales, if I sell 100 homes and the majority of those homes have been selling on the cheaper end of the curve, then the median price will go down to some degree because the middle sales, if they're all cheaper homes at higher interest rates, are going to be lower. So this is, in my opinion, a case where the presenter doesn't understand the data. He or she doesn't know what this is actually saying. In 1970 and 2008, that was in fact where prices came down because we had high inventories. We have no inventory and prices are basically flat. So home prices are not contracting sharply. That is a false statement. The median price has come back. U.S. home prices are up flat, so how can it be a housing recession? Question mark. Recession is about economic activity, not prices. During most full-blown recessions, overall consumer prices, i.e. inflation, continues to rise despite contracting economic activity and job losses. The U.S. existing home market is very much in a recession, according to him. When I look at the data, there is no contraction in existing home prices for the average market. There are pockets that have prices that have gone down. There are pockets where prices have gone up. So it really depends on how you look at this. The sales volume has contracted as well. So I am interested in a lot of these people's understanding of mathematics, statistics, and data. I really start to question it. The majority of people who failed out of engineering, they generally went into business for the most part. The people who couldn't handle all the data, they couldn't handle all the math, they quit and they go over to finance. And now I'm just seeing these guys show up everywhere because I don't know if they fully understand what they're trying to present here. Statistics show 70% of people are unhappy in their 9-to-5. But why do very few people take action to escape from it? And I think here's my take on the 9-to-5. I wasn't anti 9-to-5 when I was a young person. When I was 18, 19, 20, 21, 22, 23, I didn't know any better. I didn't know what it was like for most of these jobs. And I think what occurs for the majority of people is they go into the workforce, they think that it's 100% merit-based, where the harder you work, the better you are at your job. All of those things kind of combined means that you're going to get better raises, that you're going to be promoted first, et cetera, et cetera. And then you get out and you realize that that is not the case. It's definitely not the case here recently. There's obviously favoritism being played. There's obviously complete and utter, I'll call it, they disguise complete and blatant discrimination under inclusion and diversity. It is completely and blatant, in my opinion. So what happens is a lot of people, they're young, they graduate from college or they graduate from high school, they get a job, they do the 9-to-5 route, and then they realize, you know what, this isn't really based off merit. It's not really based off of how hard I work. It's not really based off of the projects and the difficulty of the projects. It doesn't even line up with how much value I bring to the company. So I think people are unhappy over time because it's not based off of merit anymore. It's based off of whatever the heck they want to base it off of. Gender, race, whatever it is. Oh, we need more people that are females in engineering at this level of engineering, and we'll just hire them on. Doesn't matter if they're good or bad. It doesn't really matter, and we'll bypass and skip over many other people. And some of it is favoritism. I know you, you know me. We're buddy buddy, and that's how upper management kind of works. So I think people aren't happy because of that. Nothing will be 100% fair. I don't think that's going to be the case. But I also think that they're way too skewed to unfair at this time. But I also think it's very difficult to escape from it because if you've been in a job for 5 or 10 years and you figure this out, you've got 5 or 10 years kind of already into it. You probably are making decent money. Not great money, but decent money. You probably have built up some sort of benefits and stuff like that. And it's difficult to walk away from that. And I think that's why very few people escape it because they don't have an idea of what to start up on their own. It's hard to start something up from scratch. A lot of people don't think like that. They don't want to take risks. They don't want to do that. So they stick in where they're unhappy. Not because they thought it was going to be unhappy right off the bat, but it's from being unhappy over all the years. Cuppy says, got oil. Russia, Medvedev, Europe's energy cooperation with Russia is ruined or frozen for a very long time. Hard times have come for the EU. In 2020, when I said we are in a new paradigm, that this is what I meant. Commodities versus the stock market, it's really just the commodity stock ratio. We're starting to move on up. He put a nice little ARC test deal on this, but it looks good for commodities to outperform stock market. This is from Patrick. He says, how can this be bullish for U.S. equities? Very close to a full meltdown. Expect gold and silver to outperform when this happens. This is U.S. stocks priced in copper. You can see that we are about to break to the downside where stocks are going to underperform against copper. Copper did very well in 01, 03 was the retest there. And then we had the full blowout move to the downside in 05, 06. Could we get a blowout to the downside here? If copper starts to move up and the stock market starts to move down, that's where we could get this big move lower. That could also mean, and I'll tie that in with higher for longer, it's going to cause the rotation of money over into commodities versus the U.S. stock market. And if they hold interest rates higher, the U.S. stock market needs to get repriced to a lower price if the 10-year yield is at a much higher level. I think a lot of people think that the interest rates are going to come back to a lower level. I'm not so sure of that. Powell says he's going to stay higher for longer. If those interest rates stay higher for longer, it's going to reprice U.S. stocks to a lower valuation. So that's where I'm going to end it right there, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. We do have that discount coming up called Spooky for the 30th and 31st, signaling for Halloween. So it's a Halloween special. It's only good for 2 days. 50% off on the monthly. And I'm giving a bigger discount on the yearly if you'd like to sign up for a yearly. Anybody can sign up. You can go from monthly to yearly if you'd like. And if you need help doing that, let me know. But really, you just sign up. You use that coupon code SPOOKY, SPOOKY, to get the discount. All right, guys. That's what we've got for today. We'll catch you later. This is Finding Value.